What if I told you that the specific type of savings account you're putting your money into today could be the exact reason your healthcare premiums like completely triple 20 years from now?
I mean, I know it sounds like a scare tactic, right?
Yeah.
But it's actually just the reality of how our tax code interacts with retirement benefits.
Yeah.
The decisions you make right now about where you park your cash, they have this massive delayed ripple effect.
And we are really looking into that ripple effect today. Welcome to the deep dive, everyone.
Glad to be here.
So, just to set the stage, it is April 10th, 2026, which means that infamous April 15 tax day is, literally just 5 days away.
Looming large, yeah.
Exactly. But instead of panicking, we're going to frame this as a sort of last-minute window of opportunity for you. We've got our hands on a really timely strategy guide from the Green Insurance Group.
Right, they're a local family firm down in Texas, serving areas like Seguin and New Braunfels.
Yep. And our mission for today's deep dive is to unpack the rules around these last-minute Roth IRA contributions for the 2025 tax year. But more importantly, we're going to break down how to coordinate a Roth IRA with your other retirement tools.
Because if you don't coordinate, if you just throw money into different accounts randomly, you are setting yourself up for some brutal financial surprises down the road.
Absolutely.
And, setting a calm tone here, this looming deadline, it isn't just about rushing to file paperwork.
Right.
It's actually a strategic checkpoint. It's a chance to step back and look at your entire retirement picture.
Okay, so let's unpack this.
Yeah.
Because it honestly feels like we have a financial time machine right now.
I like that analogy.
It's wild, right? We're sitting here in early 2026,
Yeah.
but the IRS allows you to make a contribution to your 2025 Roth IRA up until April 15th.
Yeah, the rules are pretty rigid on the dates, but they give you that grace period. So the limits for 2025, just to lay out the hard numbers from the text, are $7,000 for those under 50.
And then $8,000 if you're 50 and older, right?
Yeah. Exactly. That extra 1,000 is the catch-up contribution.
Okay, but here's the obvious question for the listener who is already, totally on top of things. What if I've already filed my 2025 taxes?
Right, like back in February.
Yeah, I got my refund, the paperwork is done. Am I just locked out of this time machine? How does the IRS not penalize you for changing the math after the fact?
Well, what's fascinating here is that you can absolutely still contribute, even if your taxes are already filed and done.
Wait, really? Without filing an amended return?
Yep, no amended return needed. As long as you make the contribution by April 15 and specifically mark it for 2025.
How does that work, though?
It's because of the mechanism of a Roth IRA. You are contributing after-tax dollars. You've already paid the income tax on that money.
Oh, I see.
Right. So because it's not a tax-deductible contribution, unlike a traditional IRA, putting that $7,000 into a Roth doesn't alter your adjusted gross income for 2025 at all.
It doesn't change what I owe the government.
Exactly. It doesn't change your tax liability.
Yeah.
So the IRS doesn't care. They just record that you used up your contribution space.
Mm-hmm.
They actually allow this flexibility to encourage people to maximize their retirement funds without punishing them for filing early.
Well, that definitely makes the logistics much easier to swallow.
For sure.
But, putting money away is great. The real question is why the Roth IRA specifically is such a coveted vehicle in 2026. Let's look at the core mechanics.
Right, shifting from the when to the why.
Exactly. And the primary benefit, which most people probably know, is the tax-free growth and tax-free withdrawals in retirement.
Yes. You pay the taxes now, and then the growth is completely yours.
But the guide points out a crucial detail here. Not everyone gets a free pass.
No, they don't.
There are strict income limits for full contributions in 2025. Specifically, if you're single, you have to earn under roughly $153,000.
And for married couples filing jointly, that ceiling is just under $228,000.
Right. So if you earn over that, the direct front door contribution is just phased out.
Or eliminated entirely.
Yeah. So assuming you are under those limits, deciding between a Roth and a traditional IRA, it kind of reminds me of a highway toll.
How so?
Well, it's like deciding whether to pay the toll on the highway before you get on the road versus paying it when you exit. The Roth is basically ideal if you expect the toll, like your tax rate, to be higher later when you get off.
That's a really great way to look at it.
Yeah.
And grounded in the text, choosing a Roth depends entirely on your current tax bracket versus what you expect your retirement bracket to be.
Yeah.
But the core value of the Roth, beyond just the math, is control.
Control.
Yeah. You're getting the tax burden out of the way now, so your future self has complete freedom. You aren't at the mercy of whatever the tax rates happen to be in 20
Yeah.
years.
And if we connect this concept of control to the bigger picture, it bridges perfectly to the next segment.
Right, because those tax-free withdrawals aren't just about saving a few bucks on income tax.
They trigger this whole domino effect of hidden benefits later in life. These are like the stealth superpowers in retirement.
The aha moments.
Yes. So the first superpower that just blew my mind, no required minimum distributions
The RMBs?
at age 73. It is just wild to me that with traditional accounts, the government legally forces you to take your money out, whether you want to or not.
They want their tax revenue.
Exactly. But the Roth lets you keep control over when and how much you withdraw.
Which is huge for legacy planning, but it also creates a deeper strategic ripple effect. By having that tax-free income from a Roth, you keep your overall taxable income lower on paper
Okay. And why is that so critical?
because it helps you avoid taxes on your Social Security benefits, and it reduces Medicare premium surcharges.
See, here's where it gets really interesting. I feel like most people probably don't realize their retirement savings account directly impacts what they have to pay for healthcare later.
Oh, they don't. People tend to think of retirement savings and health insurance as like two completely separate buckets.
Right, like totally unrelated.
But the government links them through this mechanism called IRMA.
IROAA.
Yeah, IRMAA. It stands for the Income-Related Monthly Adjustment Amount.
Sounds expensive.
It can be. This applies to Medicare Part B and Part D premiums. Normally, Medicare heavily subsidizes those premiums. But if your income crosses certain thresholds, the government strips away that subsidy.
Meaning you pay a surcharge.
Exactly. You get penalized.
But wait, how do they define income in that context? Because if I'm retired, I don't have a salary from a job.
They look at your modified adjusted gross income, your MIGI, from your tax return 2 years prior.
Oh, wow. 2 years prior.
Yep. And this is where the type of retirement account you use becomes absolutely critical. If you have all your savings in a traditional pre-tax 401k or IRA, every single dollar you withdraw counts as taxable income.
Oh, I see where this is going.
And remember those RMDs we just talked about? At age 73, the IRS forces you to withdraw a percentage of that pre-tax account.
Whether I need the cash to live on or not.
Right. So the government forces you to take a withdrawal from your traditional IRA.
Which spikes my adjusted gross income.
Yeah.
And because my adjusted gross income spiked, Medicare looks at my tax return and says, oh, you earn too much. We are stripping away your healthcare subsidy.
That is the exact sequence of events. And the crazy thing is, IRMAA acts as a cliff penalty.
A cliff penalty. Meaning what?
Meaning if you cross that income threshold by a single dollar, you are hit with the full surcharge for that tier for the entire year.
Are you kidding? $1?
Just $1. It can easily add hundreds of dollars a month to your healthcare costs.
So this is where the Roth IRA really flexes its muscle. Because Roth withdrawals are entirely tax-free, they don't even show up as adjusted gross income on your tax return.
Exactly. They are completely invisible to the IRMA calculation.
Wow.
I mean, you could literally pull $100,000 out of a Roth IRA to go buy a luxury RV, and as far as Medicare is concerned, your income hasn't gone up a single cent.
So your premiums just remain completely unaffected. That is incredible. Okay, let's look at another hidden mechanism the guide brings up, which is Social Security taxes. The source mentions keeping your provisional income low. What actually is the formula for provisional income?
So provisional income is the specific metric the IRS uses to determine if your Social Security benefits should be taxed.
Okay.
To calculate it, you take your adjusted gross income, you add any tax-exempt interest you might have, like from municipal bonds.
Wait, municipal bonds count toward this?
Yes, they do. And then you add 50% of your Social Security benefit on top of that.
Let me map this out. If I am pulling heavily from a traditional 401k to pay for my living expenses, my adjusted gross income goes up.
Right.
Which means that pushes my provisional income higher.
Yes. And if that provisional income crosses certain thresholds, up to 85% of your Social Security benefits suddenly become subject to federal income tax.
So you are essentially shrinking the value of your Social Security checks simply because of how you chose to withdraw your other savings.
It's a domino effect. But again, Roth IRA distributions are excluded from adjusted gross income.
So they don't factor into the provisional income formula at all.
Not at all.
Okay, so having a pool of tax-free money in a Roth is clearly a massive advantage for navigating Medicare and Social Security. But realistically, nobody has everything entirely in a Roth.
No, that's very rare.
Right. We all have 401ks from our employers. Maybe some folks have pensions or, taxable brokerage accounts. And this brings us to the primary focus of the Green Insurance Guide, which is coordination.
The jigsaw puzzle.
Exactly. So what does this all mean for different types of listeners? How do you actually coordinate these different vehicles over a multi-decade retirement?
Well, it's essentially an engineering problem. You have to build a system that can handle different environments.
Okay.
Think of your retirement strategy like building a customized vehicle, like a modern hybrid car's powertrain.
Oh, I like that.
Yeah. You need a highly efficient engine running constantly to maintain your baseline cruising speed, right? But you also need a separate system to provide a massive boost of power when you need to pass someone on the highway.
And you need to do that without overheating the entire vehicle.
Exactly.
Okay, let's apply that analogy. Because a young professional might need a totally different engine than an empty nester.
Completely different. Let's break down the demographics mentioned in the source. If you are just starting out, say you're a young professional in the accumulation phase, your immediate priority is usually capturing the full employer match in your 401k.
Because that's basically free money.
It is mathematically unmatched. It's a 100% immediate return. But once you secure that match, you pivot to funding the Roth IRA to start building a foundation of wealth.
Building two distinct buckets.
Right. A pre-tax bucket that lowers your burden today, and a post-tax bucket that gives you that tax-free leverage later.
What about small business owners? The guide specifically mentions them using SEP IRAs or solo 401ks for tax-savvy savings.
Right, because business income is highly volatile. You might have a banner year where you need to shelter, $50,000 from taxes. So you heavily fund a SEP IRA.
But then you might have a lean year where you really need cash flow.
Exactly. And a lesser-known feature of the Roth IRA is that you can withdraw your direct contributions, not the earnings, but the original money you put in at any time, entirely tax-free and penalty-free.
Wait, really? Even before you turn 59 and a half?
Yes. Because you already paid taxes on that initial seed money, the IRS doesn't penalize you for taking it back out.
Oh, wow. So for a business owner, a Roth IRA can act as a sort of stealth liquidity reserve.
Exactly. It's a pressure release valve if the business needs capital, without forcing you to take a taxable loan or an early withdrawal penalty from a traditional account.
Okay, so what about the empty nesters? The folks who are using this time to play catch-up. They might have built up a massive traditional 401k over 30 years. The guide talks about coordinating Roth IRAs with annuities.
Right. So to go back to our car analogy, the annuity acts as your idle engine. An annuity is essentially a contract with an insurance company. You give them a lump sum, and they guarantee you a steady stream of income for the rest of your life.
It covers your baseline, the mortgage, the groceries, utilities.
Yes. It provides an unshakable floor. But depending on how that annuity was funded, especially if it was with pre-tax money, that monthly income stream is usually taxable.
So it fills up your lower tax brackets.
Right. Your baseline living expenses are covered, but your adjusted gross income is creeping closer to those Medicare IRMAA cliffs we talked about.
Okay, so if my baseline is covered by the annuity, but suddenly I need to replace my roof or, pay for a grandchild's college tuition, I need a lump sum.
And if you pull an extra $40,000 out of your traditional 401k on top of your annuity income,
I am going to completely spike my adjusted gross income.
Which could trigger the Medicare surcharge, tax your Social Security, and push you into a higher federal tax bracket. The actual cost of that $40,000 roof might end up being $55,000 when you factor in the collateral damage.
Ouch. So that is where the Roth IRA comes in as the turbo boost.
Precisely. That's the overarching goal of coordination. You pull the $40,000 for the roof out of the Roth IRA instead.
You get the capital you need to navigate the spike in expenses, but because it is tax-free, your adjusted gross income doesn't move a millimeter.
Your engine doesn't overheat. By balancing a Roth with an annuity, you build a retirement plan that, as the source puts it, doesn't scare you with surprises later.
I love that. Now, let's push into one more tool mentioned in the source material, because this one honestly genuinely confused me when I was reviewing the notes.
Oh, the life insurance?
Yeah. Coordinating a Roth IRA with life insurance. I always thought of life insurance strictly as a death benefit, money that pays out when you are gone. How does life insurance function as a retirement tool while you are still alive?
Well, it requires looking at permanent life insurance policies, like whole life or universal life, rather than just term life insurance.
Okay.
Permanent policies have two components. They have the death benefit, but they also have a cash value savings component that grows over time within the policy itself.
But if I try to take that cash value out to spend in retirement, don't I have to pay taxes on the growth?
If you formally withdraw the gains, yes, you generally owe taxes, but the structural advantage here is that you don't withdraw the money, you borrow against it.
Wait, I'm taking a loan from my own policy?
Not exactly. You are taking a loan from the insurance company's general fund,
Mm-hmm.
and you are using your policy's cash value as the collateral to secure that loan.
Oh, I see.
And because it is legally classified as a loan, it is not considered taxable income by the IRS.
Okay, but how does the loan get paid back if I'm retired and just using the money to live on?
It usually gets paid back by the death benefit when you pass away. The insurance company simply deducts the outstanding loan balance from the final payout, and your heirs receive whatever is left, tax-free.
So, by utilizing these life insurance loans, I'm creating an entirely second bucket of tax-free liquidity.
You are expanding your options.
Okay.
I mean, imagine sitting down at the beginning of the year to plan your income. You know you need $100,000 to live on, right?
Yeah.
You take $40,000 from your taxable annuity. You take $30,000 from your tax-free Roth IRA. And you take a $30,000 tax-free loan against your life insurance policy.
Wow, you just generate $100,000 of cash flow, but on your tax return, your income only shows up as $40,000.
Exactly. It keeps you way under the thresholds for Medicare surcharges and Social Security taxes.
Yeah.
It is entirely about controlling the narrative on your tax return.
It's amazing how complex but manageable this is when you look at the whole board like that.
It really is. Control is the ultimate objective here.
Let me try to summarize the vital takeaways for you, the listener, before we wrap up, because we've covered a lot of mechanics today. First, the immediate action item. You have a closing window until April 15th, 2026 to use your 2025 Roth time machine. Even if your taxes are filed, you can make this move. The limits are $7Ks or $8Ks if you're 50 or older.
Provided you meet the income requirements, of course.
Yes, very important. The second big takeaway is that the Roth isn't just a savings account, it's a strategic tool. It's a shield to control your taxes, protect your Social Security, and lower your Medicare costs.
Absolutely.
And most importantly, it works best when coordinated with your other tools, your 401ks, annuities, and life insurance.
It requires stepping back and viewing your net worth as a single, cohesive operating system.
Before we sign off, I know you had a final, sort of provocative thought to leave the listener with, drawn from the source's broader financial considerations.
I do, yeah. Because we have spent this entire time talking about taxes and IRS formulas. But this raises an important question about a massive external variable we haven't touched on.
The market itself.
Exactly. What happens to your carefully constructed retirement if the stock market drops 20% the exact year you need income? That is known as sequence of returns risk. It is one of the most dangerous threats to a retiree. If you have 100% of your wealth tied up in stocks inside a 401k and the market crashes early in your retirement, you are forced to sell your investments while they're down 20%.
You're just cannibalizing your own portfolio.
Yes. You permanently impair the portfolio's ability to recover. But if you have this coordinated strategy...
It serves as the ultimate shock absorber.
Exactly. If the market crashes, you don't panic. Your baseline is covered by the annuity. If you need extra cash, you pull from the tax-free, less volatile Roth IRA, or you take a loan against the life insurance.
You give your main stock portfolio the time it needs to recover.
Right. You are ensuring that you are never forced to sell a volatile asset at the worst possible time just to keep the lights on.
That is such a heavy, important concept to ponder. It really challenges you to look at how coordinating these tools handle the unpredictable life events. Well, as we approach tax day, take a hard look at your own retirement puzzle. Thank you so much for joining us on this deep dive.